What is investor center performance and what are some of the metrics used to assess that? Well, in this video, we're going to look at residual income and economic value added. Okay, so to start with, what is an investment center? Well, it's just simply a responsibility center that is charged with making money. Okay, it is specifically formed for the purpose of allocating money towards projects or investing money with the purpose of making a return on that money. Not all responsibilities centers have the dual function of spending money and making money. Okay, so with that being said, the methods of assessment that we need to cover. First, we need to talk about return on investment. That is the key metric for almost any investment period. Okay, so to start with, if the responsibility center is allocated resources, right, its effectiveness can be measured by what is the return on that allocation. All right, so you would divide in that scenario your operating income, the income that makes, divided by the operating assets, the value of the assets injected into the investment center. Okay, this would give you your return on investment for the center. All right, another way of looking at it is residual income. Residual income is the income you have above what you expected. So if you start first by saying this is the value of our operating assets, multiply that by your expected or target, anyway, rate of return. Okay, that will give you your expected operating income. Then if you subtract your actual income from that, and whatever's left over, that's your residual income. That's what you've exceeded your target or your expectation. Lastly, economic value added. This is more of an organizational, full organizational look, but basically it says what is the net operating profit, and that's generally before taxes are assessed. Okay, or the net operating profit of the organizational unit minus its operating assets times. So what you're doing here is you're taking the value of the operating assets and multiply it times your weighted average cost of capital. What is that? The cost of capital is usually, for an organization, is a combination of debt and equity investment. So the equity investment would have an expected return based upon the risk associated with that type of investment, and then there's a debt rate of return, which is your interest rate for that type of debt. And so you would combine these two to come up with a weighted average cost between the allocation of debt to equity for the investment. So if the investment center employed some level of debt and equity investment from the larger organization, company funds or resources, in some percentage, you would take that combination of those rates of return expected for each, combine them in based upon that breakdown of debt to equity employed. Okay, you multiply that by the value of your operating assets employed. Okay, that would once again you would subtract that from your actual operating profit, and that gives you the economic value added, or the value added above your expected or obligated rate of return for that combined debt and equity investment. So with that being said, you've got three methods there: return on investment, residual income, and then overall economic value added as measures of performance for the investment center as a responsibility center.